This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. Chapter 11, Accounting for Limited Companies. Now, until now, we've been looking at sole traders and how we record the transactions, the debits and credits, how we prepare the financial statements and what they look like, and the last chapter, books of prime entry, how we actually record in real life. Well, accounting for limited companies, as far as the recording's concerned, all the recording's exactly the same. The debits and credits exactly as before. All really that changes is really terminology and the layout slightly of the financial statements. Now for this chapter, most of what you need for the exam is typed up in full, and I'm afraid there's no choice but to read it slowly and to learn the terminology and to look at the financial statements on page 83. All I'll go through in this session, all I'll talk through, are the two examples relating to the issue of shares. And so again, do read the chapter in full, but let's have a look at the issue of shares, which is page 79, because with a limited company, instead of there just being one owner, and the owner pays in capital, debit, cash, credit, capital, you've got several owners. The owners are called the shareholders. They put capital into the company, and effectively they buy shares. And it is capital in the same way as normal, and when we receive cash, debit cash, credit capital, but we call it share capital. However, one thing a bit different with a company is that although any money they pay in is effectively capital, the shares they receive have an amount printed on them which isn't necessarily the same as the price that they're paying. Let me explain what I mean, and then later we'll talk about why this happens. Example 1. A company is formed on the 1st of January 2003, and it issues 10,000 $1 shares at a price of $1.20 each. And it asks us what will appear on the statement of financial position under the heading equity. Equity is what we call the amount owing to the owners in a limited company, the shareholders. Well, they're issuing 10,000 shares, they're charging $1.20, so the cash received surely 10,000 shares, for each share they're paying $1.20, and so there's no question the total they're receiving is 12,000. Now we'll look at the debits credits after, but although they're receiving 12,000, the shares they've issued are what we call $1 shares. Now the $1 is the nominal value, and is effectively the amount printed on the share. And the relevance of it is that when we receive that 12,000, in fact we split it and we say the actual share capital is the nominal value. So there are 10,000 shares, the nominal value is $1, and so the share capital itself will be 10,000. The extra, though, that they've paid, in this case an extra 20 cents a share, we call share premium. And so the share premium, again, you've 10,000 shares. On each share, they paid an extra 20 cents, so 2,000. There's 12,000 in total, but 10,000 is called share capital. The other 2,000 is called share premium. Now on the balance sheet, You'll see later the balance sheet looks just like it does for a sole trader. You'll list the assets, non-current assets, current assets. You'll show the liabilities, non-current liabilities and current liabilities. But the amount owed to shareholders we refer to as the equity. And under the heading equity, in this example, there'll be two amounts. There'll be the share capital, which we've just worked out is 10,000. Also, there'll be share premium, 2,000. So the total owing to the shareholders will be 12,000, which surely is sensible. That's the total they paid in. But by law, it must be split between those two amounts, those two headings. Now, in fact, it may look a bit strange, why don't we call the 12,000 share capital? But the reason for it is this, that very often a company might later issue some more shares. A few years later, they might need some more money and issue another, I'm not going to do the arithmetic here, but they may issue another 20,000 shares. And of course, if they're doing this 4 or 5 years later, the company may have grown considerably and they may charge more for the shares. They may charge, let's say, $1.80 per share. Well, it'd be very confusing if we didn't keep the two bits separate. The point is these are the same shares, and so the nominal value of the shares issued would still be $1, and so the extra share capital, another 20,000 shares at $1, would be 20,000. The extra share premium, well, this time, if they're $1 shares, the extra is an extra 80 cents a share. 20,000 shares is an extra 16,000. It would be split. And so what would happen to the balance sheet after that extra issue? Share capital, surely you'd already got 10,000 shares, we've now issued another 20. The share capital would now be 30,000. 30,000, they're $1 shares. So clearly 30,000 shares in issue. Shareholders did pay more for the shares. Initially it was an extra 2,000. On the second issue it was an extra 16. Well, anything extra paid is share premium, and the share premium would now be 18,000. So shareholders would be owed 48. It was 12,000 before, an extra 36,000 on the second issue, 48,000, but always it's kept separate between share capital and share premium. Okay, that's example 1. The second example is about something we call a rights issue. Now, I just mentioned, and it's very common, that a company will form the company by issuing shares, but later they may want to raise more money and issue more shares. Well, they could issue more shares to the general public, but what's much more common and much more easy, and certainly for a small company, is if you want to issue more shares, to offer new shares to the existing shareholders. And that's what a rights issue is. It's an issue of new shares to existing shareholders. And so all the existing shareholders will get a letter offering them new shares, which obviously we'll hope they'll buy. Now, one other thing that goes with this, and remember this is not a law exam, so all I'm concerned about is what you need for paper F3. But although we write to shareholders offering them more shares, the new shares must be offered fairly. And what I mean by fairly is it would be something like, it's always expressed in this sort of form. You might have a rights issue of 1 for 4. And what that would mean is that they were offered 1 new share for every 4 existing shares. So if you had a shareholder currently who owned 100 shares, he'd be offered 1 for 4, another 25 shares. On the other hand, if you had a shareholder currently holding 5,000 shares at 1 for 4, they'd be offered another 1,250 shares. And I say that's what I mean by fairly. The more shares they currently own, the more new shares they're offered. So that's all it is. So now look at example 2. A company is formed by the issue of 10,000 shares, $1 shares note, the nominal value, at a price of $1.20. So, what's going to happen? I'll do it in little columns. How you set this out in your own workings obviously is up to you. But if we look at a column number of shares, well, this first issue, it's 10,000 shares. They're going to pay $1.20, but remember the nominal value goes to share capital. So at $1 each, the share capital will be 10,000. Any extra they pay will go to a share premium account. So the extra 20 cents a share, 10,000 shares, 2,000. So just like before, but if we were stopping now to do a balance sheet, share capital would be $10,000, share premium $2,000, the total owing to shareholders $12,000. They now have a rights issue 5 years later, and it says it's a rights issue of 1 for 5. So how many new shares will they issue? They've 10,000 currently, 1 for 5. There'll be another 2,000 shares. There'll now be 12,000 shares in issue. They're paying $3, so that's 6,000 in total. But always these are the same shares as before, so they're $1 shares, and the nominal value goes to share capital. Well, 2,000 at $1 each is 2,000. Share capital will go up to 12,000. However, they paid more than $1 clearly. They paid $3, so the extra $2 is the premium. And on 2,000 shares, there's a premium therefore of 4,000. So the share premium account will go up to 6,000. And if we were doing a balance sheet or statement of financial position, under the heading equity, share capital, it would actually say against it the nominal value. So here $1 shares, could be $1, could be 50 cents, you'd be told. But share capital ends up at 12,000. Any extra paid is share premium. And as you just saw in the workings, in total, albeit there have been 2 issues, there could have been any number of issues, but in total, here it's 6,000. The total owing to the shareholders, 18,000. Now, as I said, all I'm going to go through is those 2 examples. The rest of it, read yourself carefully. Look at the layout of the financial statements, and also you'll see one more statement mentioned, a statement of changes in equity. The notes explain what it is and why. You won't be asked to prepare a statement of changes in equity, but certainly be aware what it is and the need for it for the exam. Irrelevant for a sole trader, but certainly for a limited company, it would be an extra document that we prepare. So have a good read through. If you think you're happy about it, have a look at the test.